What's going on, Tim? How we doing?
I'm well, thank you. How are you guys? What
We're,
what did I miss this morning?
we're complaining about prices
Hmm.
of everything. I'm complaining about the price of sunscreen. I'm complaining about the price of
Well,
gear lube. I'm complaining about the price of the oil of the gas at the pumps because I see oil coming down, yet all these products that use oil going up. What's with that?
I
Why do these companies want to make so much money off of us, Tim?
I think we call it the profit motive, Dennis.
Capitalism, free
Yes,
market
exactly.
capitalism. Supply and demand, and they don't care that oil's come down. They're not lowering those prices. They raise the prices at the pumps.
Well, and to be fair to the producers, and the whole thing from upstream to midstream to downstream, where downstream is the service station, the gas station, the petrol station, midstream is transportation, upstream is exploration and production. Look, their input costs have gone up too. They're no
Labor.
different. They're no different from us. Yeah, their labor costs have gone up. Their equipment costs have gone up. Everything's gone up. So it becomes harder, I think, for producers to adjust the price at the pump to oil as a result of that. It gets to the central question of the week, which here in the U.S. and knowing that you're peering just across the border, Dennis, of the what the Federal Reserve does. Had they been serious about addressing inflation, rather than leaking out changes over 2 years, why wouldn't you just hike rates to 5%? I mean, if you really wanted to stop the use of credit infusing the market with higher prices, inflation is always, always, always about money. It is not about you, the consumer. You don't create inflation. We don't need to slow you down. The economy does not overheat. There is no such thing. There is only too much money chasing too few goods, and it happens in two ways. There is credit, the ability to borrow things and buy stuff. And if you have zero interest rate car loans for 7 years, that is infusing inflation into the system. And then fiscal and monetary stimulation, where people get checks for sitting at home. Those two things create inflation. So if we wanted better, and I was traveling over the weekend and paying almost
No, you were traveling again. Stop. I'm
almost
interrupting
$5 again. Well, this was not.
Where
so
were you
great.
this time?
So this is, it's not sad, but it's a fact. So my mother passed away. So I was
sorry.
in.
Sorry to hear that, Tim.
I was delivering the eulogy at my mother's.
Sorry to hear that, Tim.
No, thank you. So I was in Spokane, Washington, and gas was pretty close to $4.80 a gallon there. I don't know what it is where you are. It's quite a bit more than here in Denver. But that to me is the problem, Dennis. And how do we fix that? That's very simple to me. If you set interest rates at a reasonable level and left them alone and let the supply-demand equation sort itself out at the commercial level, and if you fixed the value of the currency and adjusted it only to expand according to output increases, we would we would probably have prices that would come down, because as we introduce things that should improve efficiencies, like generative AI, I mean, that should improve productivity. If you don't need as many people to do things, then prices should overall come down. It happened from 1800 to 1900, by the way. The consumer price index equivalent from 1800 to 1900 in the US came down 50%. And it's because the value of the currency was fixed. So by the time you got to the end of the century, if you lived that long, you could buy 50% more than you could at the beginning with the same money. That is a great system, but we don't have it. That's not market structure.
No, it's not. It's Tim. I want to get, and there's not too often where I'm thinking about the markets, I'm thinking about the show, I'm doing my homework, and I'm thinking, wow, what a week we have coming up.
Yes.
And I think about, the setups and the scenarios. Not very often do I get an email from our guest saying why this week is possibly the most consequential one this far in 2023. Tim.
That's a good setup, Joel.
It is a good setup. Holy mackerel. I mean, I'm not going to be able to sleep all week. Come on, let's talk about it. CPI, PPI, Fed, and Quad Witch. This is it. This is it, the week. Okay, go ahead.
This is the pre-market prep equivalent of let's get ready to rumble in wrestling.
Really, eh?
That's what that was. So So for those who aren't reading everything like we are, so I mean, you probably do the same, but whether I like it or not, I read Bloomberg, Tab Forum, Wall Street Journal, everything, right, to keep up on what's occurring. This week, there are, well, of course, there's the Fed meeting, Fed Open Market Committee meeting. So there will be a press conference and a decision, probably nothing, but it'll be interesting to see what they have to say and how the market responds to that on Wednesday. Thursday begins the June options expirations period. Friday is S&P quarterly rebalances, round 3 of the annual Russell rebalances, which, by the way, that's why the Russell 2000 took off. Back on June 2, the reason all of a sudden, wham, the Russell took off is because that's when the rebalance started. June 2, it continued last Friday, and it's already done because it's less than 5% of overall market cap. Doesn't take long. But if you rebalance, wham, it hits that small part of the market, 2,000 stocks, but only 5% of market cap.
Yeah.
So all of that's occurring. And you've got NASDAQ. NASDAQ runs hundreds of thousands of indexes. Those are rebalancing. All of that is occurring as we come out of a period where ostensibly we have come out of a bear market, that we've returned to a bear market. Plus, there's this. In the last week, we saw the greatest outflows in 10 weeks, Tab Forum, from equities. If you look at ETFs, Wall Street Journal, less than half of ETFs have seen inflows, 44%. If you look at the overall ETF complex, we're creating and redeeming at the lowest level since 2019. We have given back all of the ETF bubble in flows. And yet here the market is way up. Well, how can those things be true?
How does that add up? And this is, I saw this over the weekend too, people talking about the outflows into, and not money coming into the markets, yet the market continues to go higher. The reason, I think a main reason why, you're not seeing these big inflows is the TINA trade. It's dead. There is an alternative, and it's cash, and it's 5% here right now on treasuries. So there's a lot of, maybe older people who are like, well, I don't have to chase return. I'll just take my 5% and not worry about the markets. I think that's why it's not coming in. But why do the stocks continue to go higher if there's not inflows coming in? Like, it's not big money driving this then.
Well, then it's like the old Sherlock Holmes adage that when you eliminate the impossible, whatever remains, no matter how improbable, is your answer. And I'm going to answer it this way. So I saw a little clip from Mark Rowan, who was on CNBC last week. He was at the Economic Club of New York. And Mark Rowan is the CEO and co-founder of Apollo. So very, very large private equity firm. And he said, it was fascinating. In fact, it was so good, I paused the TV, grabbed my phone, backed it up, and recorded it, which is, of course, a violation of copyrights, but I wanted that little clip. And so he said 60% of the market is ETFs, 80% of the volume is the S&P 500. There is no alpha left in public equities. He said it hasn't been there for 20 years. He said you can buy beta, the movement of the market. I call that the wave of the market that carries all the boats. He said you can buy beta for 6 basis points. How do you know? Because that's what you pay for a passive vehicle from BlackRock or Vanguard or State Street. It's 6 basis points. He said you cannot beat the market. We are all levered to 5 large growth stocks and the Federal Reserve. So there's number one. There is a small concentration of equities that carry most of the market. Then if you add in this ETF piece, it is principally market makers arbitraging. You will arbitrage something up that is trailing the market. And if you can make a penny at a time, it's fine. I do think that means necessarily that there are arbitragers who are losing and arbitragers who are winning. But it establishes a fundamental point to me. And it's very important, traders, this is why we talk about this. Okay, what is the value of edge to you, the platform we offer? Well, among other things, it does deliver alpha. But alpha cannot be had by simply doing what you've always done. You will have to do the things that the people who are making money in the market are doing. And they're looking for supply-demand imbalances. And I'll show you where those are. And then number 2 and 3, it will show you the behavior responsible for moving the market. And it's going to show you where the money is going. That can change very rapidly. But all of those things are very valuable if you're a trader. I'm going to show you a couple of things.
Yeah,
That's
sure.
my answer, Dennis.
Let's get to the good stuff.
good
Let's
answer. He's
see
gonna
the
show us
data,
more.
the data. It's all about the graphical representations, right? Let's
It
get
is
to
to
the
me.
action.
Certainly I'm a data geek, and I love to look at the data. So when you
Yeah.
look this
And I know
screen
you're
here-
an art guy too. I mean, I see it over the corner, right?
Exactly. Oh, absolutely. Good. If you're good with data, you can buy art. So, the two go together. Here's the thing. So what you're looking at, this green and gray parts of the graph, demand, it's an algorithm. It says, let's look at all the purposes behind trading and investing and calculate their effect on prices. It's a 10-point scale. So I'm going to look at what I want to find is where is it rising? Where's demand rising? And this is supply, short volume. Short volume is the data set associated with the modified uptick rule. 2010, the SEC handed down some regulations. FINRA created a data set to track that called short volume, not short interest. Look, we track that too, but it's a 1974 measure. It is not relevant to the way that stocks are priced today, but this is. So when those diverge, that's where your opportunity is. If you short the market, then you want to find where they converge. And look how weird this is. They're not converging. That is very strange. I have only seen that one or two times ever. I just run a calculation that looks for supply and demand in a certain relationship. The supply side is very high in this group. It's almost 80%, but the demand's rising. Weird. That is arbitrage, and who's responsible for it? Quants. Passive money is doing that. That's global macro money. But you can see this. You can look and say, well, is there money going into AI? Well, there has been. Look at this immense demand scale, but it's coming down. The supply side's coming down too. So AI is not going to fall apart. But that great momentum that we had in NVIDIA is coming down. And so you should know that so you can reduce your exposure to things that will no longer give you the kind of gains that NVIDIA has.
Well, look at and go back to the momentum sector. And this is probably the first time we've seen financials, the leading sector in momentum. Like, what's up? I kind of like the value market. I hope it stays for a while here, but what's up? Financials.
So let's go look at the financial sector. We can scroll down and we could even dig deeper into this. But see,
let's do it.
There it is. Financials have rising demand, and we had this big supply divot last week, but it's turning.
Selling.
It's how sustainable that is suspect. When this happens, you get 2 or 3 days of gains in your momentum trades. And then it falls apart. And guess what happens in 2 or 3 days? Fed meeting, options expirations, index rebalances. And Joel, that's why this is the most consequential week of the year so far. We've had a great run. And now everybody's going to sort out. Are we still tracking the index? Is our assets balanced properly? If we look at the model we're trying to track, are we following it? What is our risk reward equation? Should we have insurance? All those questions are going to get answered in the next roughly week to 10 days. And so if everybody says, now we're good, then nothing will happen. But if there's an adjustment, wow, we could have really consequential outcomes. But yeah, financials, I mean, it's kind of crazy. So that's one place money is going. It's very interesting.
Catch-up trade. Catch-up.
Well, we see this with the IWM here too, which is heavily weighted smaller companies. Financials have a heavier weight in there. And we've seen this over the last 4 or 5 days. We've been talking about this. It's why I've turned bullish, because I'm seeing not just being led by 6 or 7 companies. I'm seeing more broad-based buying here right now.
That's what we wanted.
But again, to Tim's point, so many things, data points coming in this week. Does the rug pull happen here?
Exactly. And what's the reason? I always think that that's very important. What is the reason that these things are occurring? Why is it more broad-based? And I think that it's underappreciated the role that index rebalances have. Remember, I've done this before, but take the 7 largest money managers in the United States: BlackRock, Vanguard, Fidelity, State Street, UBS, JP Morgan, Morgan Stanley, $42 trillion of assets. And 70% of those assets follow models. Well, they're making adjustments. And so we can misconstrue what the market is telling us. We can look at it and go, oh, well, everybody's bullish. No, they're trying to get everything sorted out because they haven't done it this year. They didn't do it at the March expirations period because we were in the middle of this banking crisis. People did not true up their tracking. Now we're halfway through almost. 2023 and nobody's trued up their tracking. I bet the regulators have given them some leeway because of that, but you got to be there. You can't be selling a fund that says it tracks the S&P 500 and you're not tracking it.
Yeah,
so that can lead to a misconstruction of the motivation of the market. So be very careful, people, not to get caught out in that. That's it. You got to be aware of these risks in the market.
And that's why, you know, on the show, sometimes I talk about the ETF effects, which are so significant and understated by the overall market because they don't understand it. And I mean, it's all just, you know, like I've got this trade, and I've talked about this with you, Tim, where you see, you know, on those days that Meta reports or you get Apple reporting or Microsoft reporting, and they blast off, and all of a sudden you start seeing stocks, you know, like Procter & Gamble going down, or you start seeing, you know, Pepsi going down, Comcast going down. It's like, well, why are these stocks tanking? Well, you got Pepsi and you got Comcast and you have 20 other stocks, Procter & Gamble not one of them, but you have other stocks that are part of the queues. Exactly. And if they're buying this tech-heavy part of the queues, they're going to sell the non-tech components of the queues, which is absurd that Pepsi goes down because Microsoft had a good quarter, but that's the kind of market we're in.
It's a very good point. Trend followers do that. And most of the time, money is fully invested. So if I decide, oh, we need to buy Meta, I'm going to have to sell something to free up cash to do that. And that's what's going to happen. You're going to see the lower volatility value plays decline. And it's not because people don't like them. It's exactly what you're saying, Dennis.
Awesome. Like always, guys, you guys can check out Market Structure Edge. Take gains, not chances, right? We'll see what happens today. And of course, it feels like that's the type of market we're in right now. We'll have to find out. You guys can get 30-day trial. There you guys see it. Market Structure Edge. Just threw up the link in the chat. We'll get you on over. Like always, you guys can also check out Tim Quas on Twitter. He's always active, and definitely check out his webinars if you guys want to learn more of how you can be using Market Structure Edge. Have a good one, Tim.
You guys too. Thank you.
Thanks, Tim. We'll talk to you next week.